Welcome back to another edition of the Kansas City Commercial Real Estate Market Pulse, sponsored and hosted by Exchange Commercial Real Estate. I'm joined by the talented Katie Cobb Sullivan. How are you today, Katie?
I'm good. How are you?
Doing fantastic. The Kansas City Royals got a first playoff win since I don't know when. I think it's been 8 or 9 years potentially, but everybody's excited about that. Chiefs are 4-0. Kansas City is booming. Lots of fun things to talk about today. I'm excited for a couple different reasons. The first being, after last week's, 2 weeks ago's Federal Reserve federal funds rate cut, we now get to report back kind of on the anecdotal data and conversations that our team is having in the commercial real estate space. And there's been a lot of buzz, a lot of reports, a lot of information coming out talking about the implications of the signaling of future Fed cut rates, where we're at today, and what's going to be happening. We're going to cover all that today on the Market Pulse and more. And our aim on a bi-weekly basis is to deliver value. We're bringing up-to-date information on the Kansas City commercial real estate market. That's listings, that's market trends, transaction overviews, and of course, bringing on guests and having expert insights with us joining here every single other week. And so today, we had Katie and myself talking about sort of the implications of what's going on in the commercial real estate space, specifically because of interest rate cuts and what that might look like in regards to how the next 90 days shake up. So very excited about that. If you don't know who we are, this is us. We are based in Kansas City, Missouri, Exchange Commercial Real Estate. Like I mentioned, Katie is joining us today. Here's our team. We can help you in regards to understanding your commercial real estate portfolio, doing portfolio performance audits on a regular basis, working with a lot of out-of-state clientele looking to enter into the market. We're helping property owners list their properties, lease their properties on a regular basis, and more. Multifamily, retail, industrial, and a little bit of healthcare and medical office. So we cover a broad range. So if you're interested in talking with us about Kansas City commercial real estate, stay tuned and definitely get in touch with us. All right, Katie, I think this is extremely important for people to understand. And what we're going to be doing here on the Market Pulse every single week is working to know our market better than anybody else, right? When you think about a client that is interested in buying or selling commercial real estate in Kansas City, what should they know, Katie? I mean, what should the brokerage firm that they are working with understand better than anything?
Well, they should be the experts. They should know what's happening, how many units are moving, the price of those units, just what's going on. You certainly don't want to walk in blind and just say, hey, we're going to put this for sale and just see what happens.
And this kind of came up because we saw some new listings enter into the marketplace this past week. And this gentleman and this owner decided not to engage a commercial real estate agent that's local. Now, they are listed or they are licensed in a different state. But it was very interesting to see that he took all 6 of his properties to market by himself. And it got me thinking, one of two things. He didn't believe that there was enough value brought from a brokerage firm, that they didn't know their market well enough, or he has had some bad experiences with some agents and brokerages in the past. But it's just very interesting perspective to have someone who lives out of state list their own properties. And that's not the only example. We see this quite often, honestly. We'll see a lot of people just, try to sell their property by themselves, off market, and over again. I continue to try to tell people and let them know that if you want the highest price for your property and potentially the lowest time to effectuate a sale, working with an expert is extremely important to that process. And so we wanted to make sure that we just on a regular basis are bringing that type of information to the market. And so last year in Kansas City, we know that just over 10,000 units on the multifamily side were sold for around $979 million, or at an average price per unit close to about $95,000 a unit. I also know that we sold around $33 million of multifamily properties, and that translates to about 3.43% of the overall market. We know that our vacancy rate somewhere between 5.4 and 6%. Our average asking rents are $1,182. There are 3,894 units under construction. 3,600 are in pre-lease, and there's over 13,000 units planned. And additionally, there's 42,000 prospective projects. Not only that, the 2024 monthly average pre-lease absorption rate is 130 units per month. Multifamily starts are at a 10-year low, and deliveries in 2020, 2021, and 2022 were all above the long-term historical average. And that is information that is on a macro level of Kansas City, but there's so much more inside of this. And it's why we put together our Kansas City Deal Navigator. We aimed to break down every single submarket and make it extremely accessible for someone who wasn't familiar with the Kansas City area to understand where the path of progress is moving, where development is happening, and where you may want to focus on your investments. And that is free on our website. Head over to XChangeCRE.com and you'll find it at the top of our webpage. It's a 10-part email series that really helps you get educated on the Kansas City market. Not only that, you're going to get a 50-page ebook written by myself and designed by Katie Cobb that's going to allow you to really have a good resource and understanding of the Kansas City market. If you want to learn more about that on the multifamily side, retail side, industrial side, or the medical office side, definitely reach out to us. But this is the type of information that is good to have as data. But then as an advisor, you really need to take this data, break it down to the certain submarkets, and be able to advise clients on what they should or shouldn't be doing in regards to their portfolio. And that's what we're going to talk a lot about today. And going forward, when we speak to a buyer or seller, Katie, I got a question. Do you believe that they think that we know our numbers or not?
Oh, well, they know that we know our numbers. It's the whole, like, if you can't measure it, you can't manage it. So we certainly know our numbers, because if we don't know what's out there, it's really difficult for us to do our jobs for our buyers or our sellers.
We often get asked, what makes you different in the marketplace? And, it's a little bit of a loaded question. I always go back to kind of the intellectual capital model, which is it's people, it's processes, it's data, and then it's systems, right? Inside of that, there's obviously a lot more in regards to the way that you market the properties, your inbound leads that you are having, your email list, your reach that you can get for a certain property. But a lot of times, the marketing strategies that brokerages use are very similar, right? And that's not necessarily a differentiating factor. One thing I think that we're doing very interesting is these types of informational webinars and podcasts, because it's important to get information out on different platforms. So we are streaming here live on LinkedIn and on YouTube. So definitely check us out on LinkedIn and on YouTube. But LinkedIn is one of the fastest growing. It's the largest. It's the fastest growing business to business platform in the world. And we are utilizing LinkedIn on a regular basis. I can't tell you how many times I'll put a post up and in my inbox, I have 5, 6, 7 people reaching out and wanting to learn more about Kansas City. So definitely reach out to us on LinkedIn if you're interested in Kansas City. And that's helping in a lot of different ways, because that reach, myself alone, having over 28,000 followers and being a LinkedIn top voice, is getting properties, transactions, buyers in front of their respected parties and what they're trying to accomplish. And so, yes, you have to know your numbers. Yes, you need to be able to advise, but you need to be also thinking about how to market properties differently in today's day and age. So with that all said, let's move in to what happened 2 weeks ago. So the Fed cut rates by 50 basis points, bringing the federal funds rate down to 4.75 to 5%. and they're signaling more rate cuts to come. So this is the Fed dot plot, which shows the funds rate falling to 4.25% to 4.5% this year, suggesting one more 50 basis point move or two 25 basis point cuts at the two remaining meetings this year. Another 100 basis points cuts are projected for next year, and this represents 8 rate cuts through the end of 2025. In the June dot plot, there were only 5. This means the Fed has adjusted their rate expectations significantly downward, moving toward market expectations. And so you can see those differences here yourself. And look, I think that regardless of the magnitude of the cut 2 weeks ago, the forward guidance provided by the Fed is very helpful in providing the markets with a better indication of the magnitude of cuts moving forward, which helps deliver the most needed component in our market, which is certainty to investors. And that's on the rate outlook for the near term. The Fed's also going to continue to maintain the current pace of quantitative tightening, allowing an average of $60 billion in treasuries and mortgage-backed securities to roll off its balance sheet each month. And so while we might be sitting here saying, well, rates have not come down all that much. Yes, we understand. And we talked a lot about this 2 weeks ago, that the market was already pricing in the rate cut that happened 2 weeks ago. However, the forward guidance is extremely important to bringing some certainty and stability to the commercial real estate market, which allows for people, investors, to underwrite their properties correctly and have some certainty of what they can expect in the future. And I am very excited for that. Now, is it going to say are we going to see this massive wave of transactions right now? No, I think there's a grace period, and we will talk about that lag here shortly, but there's going to be a grace period. And it reminds me of during the COVID period when the Federal Reserve cut rates to basically 0%, the federal funds rate to 0%. However, there was a big issue in the marketplace is, are people going to continue to pay rents? What's going to happen with the lockdowns, with retail and all these components? And people stayed on the sidelines. Well, there was a great period there where the basis, and we'll talk about the Green Street Property Price Index here shortly, but the basis of commercial real estate was at a trough and the federal funds rate had come down. And so there was this nice confluence of low rates, good basis, and that is what I'm going to be seeing and what I'm prognosticating is going to be happening here over the next 6 to 9 months. And so there will be what I think a first mover's advantage here to allow for the smart investors to be getting in at a good basis and figuring out how to get the debt on the projects that they want at the right period of time. So, Katie, I know there's been a lot of talk about this cut, and a lot of people saying, well, we just haven't seen these interest rates really come down at all. And in fact, the 10-year treasury moved up. So what's going on? What in your perspective, how is this going to help people, buyers, sellers come together? And do you see the commercial real estate transactions starting to pick back up?
I definitely think that they start to pick back up. I was actually reading a LinkedIn post, and I wish that I would have jotted down his name, but he was talking about basically that now is the time that you really should be hopping in while interest rates are still not going down, because by the time you wait for them to go down, you'll have so much more competition. And he's like, refinancing and all of those things are still an option. So I think it's an election year. So I still think that that's the other component. Yeah, interest rates, but the election. And then the other part of it is that you have some people that are sitting there saying, hey, historically, because I went down the rabbit hole of historically with interest rates, after Feds cut interest rates on average, that 18 months after that we dip into a recession or a soft landing. And so I think that there's still some speculation there, but the guy was like, if you wait for all of those things to pan out, you're way behind the curve.
Yeah, exactly. And I think Dr. Peter Lindemann has said this best. And he said earlier this year, if you have capital and you have courage and you have a long time horizon, you're going to do all right in commercial real estate. And so right now is a very interesting period of time where people are still playing the wait and see game. And the smart money is starting to make moves to lock up deals at today's basis. So that's very exciting for us. Now, let's talk about this, all right? Because the Fed cutting rate is going to signal pricing inflections ahead. So looking at 2024's investment, the rest of 2024's investment outlook, look, there's a release of dry powder, which should add fuel to the fire. Capital has been building up on the sidelines. I've seen reports up to $500+ billion. And amidst financing hurdles and softer fundamentals, they are starting to release that capital, right? So that backlog is starting to flow back into the sector amidst positive trends. National vacancy held flat across the first half of 2024 after rising by 90 basis points last year. That's boosting people's sentiment. Indicators of returning institutional level activity are emerging as well, with preliminary July to August 2024 data showing rising dollar volume in that segment. That's a big metric to watch. Further fueling investor appetite, primary markets had the most stable vacancy over the past year, especially in downtown areas. Now, buyers need to be wary of supply headwinds, and they're starting to target the Midwest. Outside of a handful of Sunbelt markets, many other locations are facing relatively mild supply pressure. One of the things that we covered earlier in the year was the massive amount of supply of multifamily units coming online. Now, retail, industrial, a little bit of a different story. But on the multifamily side, levels that we have not seen in over 10 years. So amongst the top 10 major United States metros for rent growth over the year ended in June, gains in places like Kansas City, Chicago, Cincinnati, Cleveland, Milwaukee, Pittsburgh, and St. Louis were aided by sub 2% inventory expansion. So I think that is another trend to continue to watch and something that is music to our ears, right? Kansas City has continued to land on the highest year-over-year rent growth, and there's many reasons for that. Not the amount of supply that's coming online here in Kansas City versus some of the Sunbelt and or other markets. And we've broken that down in previous market pulses in detail. So please go find our previous recordings and shows specifically on that. Now, anecdotally, I will say that deal flow is heating back up. But based on preliminary data, national trading activity from July to August was trending upward relative to the prior 3 quarters. That momentum should persist as lower debt costs and higher cap rates reopen the yield spread, allowing more deals to pencil. The average, let me stop here. If you're not listening, listen now. The average multifamily cap rate for trades completed from July 2023 to June 2024 rose to 5.8%. That's an increase of 110 basis points from 2022's all-time low. This is representing the highest recording since 2014. I'm going to say that again. Cap rates are at a 10-year high, the highest recording since 2014. So sales prices, meanwhile, they're stabilized as reducing financing uncertainty helps buyers and sellers come to terms. It felt like 15, 16 months of buyers wanting tomorrow's prices, sellers wanting yesterday's prices. And we are starting to see that gap being bridged in the marketplace, which I am so excited about. And anecdotally, we'll say with us working on 3 or 4 projects currently for clients, that is the case happening. And I will say this too. Previous transactions that had assumable debt that were below 5% were very attractive. And those are the types of deals that were getting done. Then it moved to smaller multifamily. Smaller multifamily gets financed by local regional banks, typically, because it's some sort of component of value add. And so that capital, in talking with a lot of banks and talking with many mortgage lenders and mortgage brokers, is starting to get opened back up, which is allowing people to have more sources for their number one size piece of the cap stack, which is their debt components. So I wanted to just talk about how I see the 6 impacts on commercial real estate really quickly. Now, Katie, there's 6 of these things. There's a lot to cover here. I'm not sure we'll get into every single one of them, but I do want to call out a few of these on these slides. The first one being the boost to financial market liquidity. Okay, this has kind of been a theme for today's show, but the rate cut suggesting an easing of financial conditions and a shift towards a more neutral monetary policy. Now, we all know we are still in a very restrictive space right now. The Federal Reserve believes that neutral rate to be somewhere around 2.5 to 3%. Okay, but this is promising positive outcomes for commercial real estate fundamentals and for cash flow. We've already talked about the movement of dry powder, somewhere between $300 and $500 billion in global dry powder, meaning cash on the sidelines that has been raised, that is poised to be back into the market in commercial real estate. All of this means lower costs for borrowers. The reduction in the secured overnight financing rate, or SOFR, by 50 basis points makes floating debt cheaper. Now, this is an interesting component. Makes it cheaper. Rob Meehan of Greystone talked a lot about this 2 weeks ago, that as rates are coming down, now those adjustable rate mortgages, those floating rate debt, that to bridge a project that has some value add components is now looking more and more attractive to borrowers. And that is going to be a big catalyst in regards to getting transactions done. Anything here, Katie, that you wanted to cover on these 3, or which one stands out to you on these 3 impacts to the commercial real estate market?
Just the lower cost to borrowers. I mean, the cheaper debt. There's so many times that deals just don't pencil for investors just because the costs. So it looks like we're kind of, like you said, bridging the gap, and hopefully making some of those deals that were so close to working before now will be beneficial for both parties.
So many people have been waiting for more liquidity, waiting for lower cost of borrowers. And we're in this period of time now where that has been signaled. It hasn't really happened yet. It's been signaled. And so now you're waiting to see the big institutional money make those moves. And I always call this the Google or the Amazon or the Apple effect. When they take a big bet and move their office or open up a new logistics facility. I mean, we talk about what Meta has done in Kansas City, or Panasonic, or Google, any of these different large companies. There's always a trickle down effect. And I have spoken and written a lot about that waterfall effect in the commercial real estate industry, but the same on the financial side as well. When those players start to make moves, they have a lot of resources behind them to be watching and underwriting and looking at the data. They start to make those moves. And a few weeks back, we highlighted KKR and Blackstone and Goldman Sachs and a few of those other larger companies making big moves into the market. Okay, let's move on to the next 3, right? Because I think that this is, 3 more of these impacts on the commercial real estate market that I think people need to be thinking about, which is stable long-term rates. Like, holy cow, if you could now underwrite a project and you're not worried that the Federal Reserve is going to continue to raise the rate while you're underwriting your project, and they very well may be reducing that rate while you're under contract, that is a thumbs up for you on your commercial real estate deal. Because if you're sitting there and you have to guess on where interest rates are going to be and they're going to be rising, that's going to, 1, not give you the confidence to move forward, but 2, realistically, you have no idea what your debt is going to be on a project. So having some stable long-term rates is absolutely fundamental to making sure that the commercial real estate industry, which is very capital intensive, is able to be stabilized. We've talked about the improved debt conditions and optimizing cap rates. I'm going to say it again. Multifamily cap rates are now at a 10-year high, not levels that we have not seen since 2014. Yes, we still have high levels of debt from an interest rate standpoint. Yes, there's still some questions around the economy. I just read a report this morning, though, that the economy is soaring high. Now, there are other issues, right? The election, how is that going to impact the rest of the year and going forward? Sure, all things to be thinking about. But when I speak to investors who have been in the market for 10, 15, 20 years, they're typically looking at the cost per door, the cost per square foot, What's the replacement cost? What's my cap rate? What's my cash on cash return? Do I feel comfortable at this basis? You look at that project and say, if I can get in at this basis and I feel very good about holding this for a longer period of time, I will be able to either refinance or find a capital structure that makes sense. And so all of those confluence, the 6 pieces that we talked about, the boost of financial market liquidity, the movement of dry powder, lower costs for borrowers, stable long-term rates, improved debt conditions, and optimizing cap rates are all going to be factors and big impacts on the commercial real estate market that we'll see, I think, in the next 90 to 120 days to really drive transactions and property price values up. Anything I missed there on the 6 impacts, Katie?
No, I think we covered them.
Fantastic. So one of my favorite things to always do is look at the basis of commercial real estate. I'm not sure there's probably a show that's gone by that I haven't mentioned the Green Street Property Price Index. There's other property price indexes out there as well. CoStar has one, TREP has one, but this one is widely available for you to go and look at. This is data that you can find for free on Green Street's website. And right now, the market is recovering from the trough following the fastest rate hikes in history. So according to Green Street, the indices was at 135 pre-COVID. Okay, so you can see that. If we look over here, right around 2020, right, we're about 135. All right, there we are, 135 pre-COVID. Prices plummeted during the beginning phases of COVID. In response, the Fed cut interest rates and we peaked at 155. So we can see prices troughed all the way down to 120. And then what did the Fed do? They cut rates to basically zero. And we started climbing, right? We started climbing and we peaked at 155 right here, 155 in May of 2022. Prices then troughed in January. So come back down because we saw the fastest rate hike in history. Prices started to come down, right? In 2024, in January, we troughed at the index at 121. So we're now seeing a rise in property values again. So you can start to see right here, 24, we're about 125, right? With projections suggesting an increase in the next 12 to 15 months. And that's a 3% increase in values this year. So if you're sitting there and you're a property owner, timing the top of the market is very, very difficult. But here's what I would tell you. I'm going to give you some advice here in a few slides, but I'm just going to highlight this really quickly. If you are sitting on a property that you're looking to either refinance or you're looking to sell, buyer sentiment is changing, the debt conditions are changing, and transaction volumes are going to start picking back up. Now, a lot of times when we're working with a property owner, they are saying, look, we don't want to sell because we don't know what to purchase. And we need to do a 1031 exchange. Okay, well, if we are to wait longer and continue to see property prices rise, which we don't know, we can pull out the crystal ball, but we don't know how long that will increase. If you're looking to go purchase another property, then your price on that property is going to be higher. So again, a really interesting period of time right now to evaluate looking at the performance of your project, where it's located, what the demand is for it, and getting ready to go to market if you're looking to sell. Because if you're looking to buy as well on the other side of that transaction, you want that low basis as well. So always love tracking the Green Street Property Price Index. Now, today, I was on LinkedIn like I am every single day, and I was checking out Commercial Real Estate Analysts page because they put out some great content. And they had 10 capital markets observations from a discussion with Eastdale's president. And I thought this was fantastic. Probably one of the most comprehensive overviews that I have seen in regards to the capital markets. And yes, they pointed out it's great news for borrowers. So borrowing rates are down 175 basis points from 6.75% to 5 to 5.25%, driven by big drops in base rates and spreads. There's debt liquidity is up across the board. Construction loans are still priced at nearly 8%, and that's mostly debt funds. but could see coupons come down to 6.5% over the next year as banks, especially large banks, continue to get back into the market. Now, one thing they mentioned, and we don't talk a whole lot about office, but there's still very little debt for office, but REIT bonds and CMBS are charting a path. There's a 5% coupon for mid-30s LTV, CMBS pricing around 5 to 7% coupons at 10 to 11% debt yields. And balance sheet lenders remain on the sidelines, but liquidity is gradually coming back up, right? And so I thought that this was a very good overview, and it goes into talking about multifamily and buyer pools and fundraising. But the main takeaway for me was that liquidity is up across the board. Rates will be coming down, and it is a good time to start evaluating either selling or looking at for your next investment property here. Now, one of the things that I always love to talk about is the commercial real estate risk premium. And that is the difference between the average cap rate and the 10-year treasury. Look, we're going to get some updated data here for 2024. I'm showing this up to 2022, but I'll get this updated to 2024 because there is some new data out from Marcus and Millichap that we can showcase. But there's typically a 9 to 12 month delay between interest rate changes and their impact on cap rates in the commercial real estate market. And here's why that lag happens. It's a transaction speed. Commercial real estate transactions, they take time. Often months. So interest rate changes aren't immediately reflected in cap rates. We have long-term leases. So with those leases, the impact of market shifts like interest rates, they take time to influence a property's income and their valuation. Market sentiment. Investors often wait to see if rate changes are temporary or they're here to stay before making cap rate adjustments. Financing. Even as rates rise or fall, many investors have existing loans or with fixed rate rates that delays the impact on new deals. In regards to the data lags, commercial real estate data reporting isn't immediate, which adds to the delay in how quickly investors react to interest rate shifts. So the timeline is more like this. There's 0 to 3 months. That's when the interest rates begin changing. 3 to 6 months, investors are starting to adjust their expectations and underwriting models. And then 6 to 12 months, cap rates start adjusting as deals close under the new market conditions. So I just want everyone to realize in our market, the commercial real estate market, there's typically a 9 to 12 month delay between interest rates and the changes on cap rates in the commercial real estate market. Katie, any thoughts on this? Because I thought this was really interesting.
No, I've before you share that, I had not seen that. So I think it's super interesting. Just how they correlate with each other and you track them over time. I have not seen the updated one from Marcus Millichap, but I would be interested to see how it pencils on there or how it's illustrated.
Yeah. So if we were to look at this and extrapolate this into 2024, you would see that average cap rate in the 10-year treasury was very slim, closer to 200 basis points. So closer to about 2006, but starting to see that gap widen, why is that important? Well, that is important because that is basically the gap between buyers and sellers being represented in a chart in real data in real time. So excited to see that gap start to widen and have a little more leniency towards the commercial real estate market. The other part of this is that cap rates and interest rates, they don't always move in lockstep, and they could be less correlated than you think. I mean, just take a look at a couple of these charts from Dr. Peter Linneman, right? I mean, cap rates are a measure of the potential return on an investment for a commercial real estate property. They're simply calculated by dividing the property's net operating income by its purchase price. On the other hand, interest rates are the cost of borrowing money and play a crucial role in determining the cost of financing the real estate purchase. And so Dr. Peter Linneman found that there's a correlation between cap rates and interest rates, but that relationship is not always straightforward. For example, in some cases, rising interest rates can lead to a decrease in capitalization rates, which can reduce the potential return on investment for real estate investors. And conversely, in a low interest rate environment, cap rates can increase, providing investors with higher potential returns. And so their research also revealed that the relationship between cap rates and interest rates can be influenced by a number of other factors, which includes market conditions, supply and demand dynamics, and changes in the broader economy. So let's take an example here. During periods of economic growth and low unemployment, demand for commercial real estate typically increases, which can push up cap rates and produce and provide investors with higher potential returns. However, they found a different correlation, which I think is very interesting and flows all back to what we've been talking about in regards to capital flows. So they measure capital flows, which refers to the movement of money into and out of a specific investment or asset class in order to determine the impact on cap rates. And they found that capital flows have a much greater impact on cap rates than interest rates do. In other words, changes in demand for investment opportunities and investor preferences have a much bigger influence on cap rates than interest rates alone. And so I think this just highlights the importance of understanding the relationship between cap rates and interest rates. But just saying that interest rates are going down and so cap rates are going to go up, that has not proven to be the case. I mean, look here in 2009, 2012, 2019, 2002, there are all periods of time where that wasn't the case. So why am I bringing this up? I'm bringing this up because I continue to mention that grace period right now where people are still waiting and seeing. Interest rates look like they're coming down. They are coming down. Cap rates are at least for the multifamily side, are at a 10-year high, right? So that is an interesting period of time for an investor to not time the market, but understand the market dynamics and where we're at currently to make some investment decisions. Was this a surprise to you, Katie, whenever we were talking about this?
Yeah, a little bit, because I thought that they, when you were saying that they don't move in lockstep, to me, I was like, oh, like they kind of go hand in hand, and that obviously is not necessarily true.
Yeah. And I mean, it is one big impact, but I mean, supply and demand definitely plays a part in this. What's going on with the economy definitely plays a part of this. Market sentiment and market and investor psychology play a big part in all these things. And how do you understand this for the market that you're interested in? You need to be talking with an advisor who is looking at these types of flows, capital flows, metrics, and can correlate that data and information alongside what's going on in the multifamily, retail, industrial, medical office side in their specific market. Because I will tell you that the cap rates in Kansas City and the trends that we see here are going to be completely different than what we're going to see in Dallas, Fort Worth, or Phoenix, Arizona, or Nashville, Tennessee, or New York City. And so this is a macro view of cap rates and interest rates, but we need to take that micro approach and work with advisors that are on the ground every single day with commercial real estate. And if you're not sold on this yet, let me just give you an example here. Let's take the single tenant net lease market, for example, because many investors I speak with believe that, once the Fed lowered rates, lower cap rates are going to follow and their property value will rise. But what they're overlooking is that there could be a big supply already on the market. So let's say there are 200 properties on the market right now selling for a 6% cap rate in the single tenant net lease market. Just because the Fed starts to lower rates does not mean that prices automatically change. That inventory has to be sold through, right? So if you own a Chick-fil-A or a Starbucks and you go to market and you say, or you're talking with a broker, so, man, I'd really like to sell this at a 5% cap rate. And the broker says, well, I understand that's kind of where you're at in regards to where you want your price to be. But let me tell you a little bit about what's going on and what's on the inventory market right now listed. And what is that listed for? Because that's going to have a huge impact. Just because the Fed starts to lower rates doesn't mean that we can go list your property for 5% cap rate when there's already 12 months of supply of unsold inventory already sitting on the market. Katie, was I clear with that? Does that make sense in regards to understanding that, the interest rates coming down doesn't just mean that you can go get another, a lower or better price for your property? We have to take into consideration what's on the market currently.
Yeah. And it plays into what we first talked about of just of knowing your numbers, that if you're like, oh, I'm just going to list it and the broker goes, oh, I'm going to take that listing or whatever, you're going to be incredibly displeased as a seller when your property sits, not knowing because your broker or whomever you hired went ahead and took the listing and it's just sitting there because there's such a supply.
Exactly. So here's how we're advising our seller clients right now. And as we've discussed, we've seen significant shifts in the real estate market over the past few years and the past few months. The Green Street Property Price Index shows that we peaked at 155 in May of 2022. That was before the fastest rate interest rate hikes in history brought prices down to 121. However, prices are now recovering, sitting at 125 and projected to rise over the next 12 to 15 months. Given the cyclical nature of the market and the challenges of timing the peak, now is an excellent time to explore selling your property while prices are on the rise. That's how we're advising our seller clients. We're working with them, understanding what amount of debt do they have on the property? When does that come due? Because one thing we haven't mentioned is there still is a wall of $2 trillion in commercial real estate loans to come due over the next 12 to 24 months. That is going to have an impact on our market, and we will definitely be detailing that in future episodes. But thinking about that right now, if you are looking to sell, it could be a really good time to capture that positive momentum and sentiment that's in the marketplace. So that's how we're advising our seller clients. Now, on the flip side, if you're looking for, a 1031 exchange replacement property, or you're looking to increase your portfolio in a specific area, we're using the current bottoming out of the real estate market as a major point of urgency, right? We're highlighting how the Fed's signaling of interest rate cuts could create opportunities for buyers to lock in favorable rates at a very low historical basis, right? On the single family home side and multifamily side, check this out. The rise in interest rates has caused significant construction halts. And while deliveries of new commercial projects are strong this year, the next few years will see lower supply. And that creates a unique opportunity for buyers to secure properties before the market becomes undersupplied, which could drive prices higher, right? So additionally, single-family residence prices have continued to increase substantially, and many analysts believe that commercial real estate has already reached the bottom. And we've shown that in regards to the Green Street Property Price Index over and over again. So that makes now a strategic time to invest. With the Fed signaling potential interest rate cuts in the near future, this supports the idea that the market is ripe for buyers to act before that competition increases. So depending on if you're a seller, if you're a buyer, if you're both, right now, when you're working with an advisor, definitely ask them, how are you advising buyer clients? How are you advising seller clients, and why? So important. And my favorite slide every single week or every other week is talking about the 8.6-year real estate cycle and where we may be or may not be. But let's just take a look at this and dive this in, right? So this is a recurring pattern that's been observed in the real estate market for centuries. I often advise investment opportunities phases, and understanding these cycles allows investors to make informed decisions about when to buy, when to sell. The cycle consists of 4 key phases, with each playing a vital role in determining the right time to act in this market. It's number 1, the recovery phase. That's when the market begins to recover from a downturn. Prices stabilize, demand starts to increase as investors regain confidence, and this phase is marked by low interest rates and renewed optimism. Think about 2011 all the way up to 2020, okay? And I will say that the 18.6-year real estate cycle, give or take 1 or 2 years, you can't ever time this perfectly. However, it is typically 14 years up, okay? So we have a 2011 up to 2020 with a 7 to 8 year mid-cycle slowdown, right? So that's right here, mid-cycle slowdown. And then another 7 years up, right? So we have our mid-cycle slowdown, 7 years up, that's 14 years up and 4 years down. Where are we at right now, Katie? We are in 2026. We are in the winner's curse. And this is when the market reaches a peak with assets prices going up significantly, overvalued due to excessive demand and speculative investment. Investors become overconfident, believing the market's going to continue to rise indefinitely. And this could be a dangerous phase for people, as prices can get unsustainably high, as we saw in 2022, leading to an inevitable correction. So where I think we're at right now, we're in 2024, the last quarter of 2024. I think 2025, barring any sort of major geopolitical risk that continues to happen or expands, and the election goes smoothly and democracy is continued, that 2025, 2026, we continue to see prices rise. But again, timing that market is extremely difficult to do, and buyer competition and more competition will be in the market at that time. After that, I think we see a decent amount of contraction and we get into kind of this recession phase. So I think for the next 2 years, I'll say 15 to 24 months, we're in a pretty good period. And what does that mean for you if you're a seller? Well, you've got some time potentially, and it's time to think about, do I want to own this long term? Do I want to own this through the next big downturn, or do I want to get out of this project? If you're a buyer, hey, right now, prices could increase. I know a lot of people who buy properties and in 2 years, they're trading out of those things because they've added value and they're capturing the next buyer who wants a stabilized project. Could be a good time for the next 12 to 24 months to be able to get some fixed rate debt at a level that you can control and feel good about and add some value to a property and sell into the highest point of that market. So love always going through the 18.6 year real estate cycle. We'll continue to track this on a regular basis for all of our clients. It is a framework to keep in mind. I am not sitting here saying I have a crystal ball and know exactly when prices go up, prices go down, but you better be aware of these different cycles, the recovery, expansion, the winner's curse, and the recession phase. And all markers right now with what's going on that we described for the last 46 minutes showcase the idea and the philosophy that right now is a good time to be thinking about transacting your commercial real estate projects. Okay, Katie, what did I miss on my favorite side, the 18.6 year real estate cycle?
Well, so I actually went on a little bit of a deeper dive earlier this week, looking at the 18-year cycle, just because I think it's interesting, especially historically. And so they were talking about, I wrote down a few facts because I wouldn't remember them, but since 1990 that there's been 6, and setting aside COVID cuts, 6 federal rate cuts since 1990. And they said on average, and they said take that with a grain of salt, average, that 18 months following that usually a recession or a downturn happens. So like when you're looking at this, like we just had a rate cut and they're anticipating some more. And so you're like, you know what, it actually follows this really well. And so they were like, but you also have to take it with a grain of salt, because they said in 1995, they cut the rates and it took 69 months following that for a recession. And they argued that that was more of a soft landing than a full-blown recession. So, and like, they're like, oh, history repeats itself. And I'm like, absolutely. When you sit there and you look at all of the historic events and when it happened, and it literally followed this exact thing, like you said, give or take some time.
Absolutely. And one of my favorite quotes is from Mark Twain, said something along the lines of, history doesn't repeat itself, but it often rhymes. And that is something that we need to make sure that we are aware of on a regular basis. And understanding this framework allows us to advise our buyer clients, our seller clients, and be thinking about the historical perspective of the commercial real estate industry. Well, that really wraps us up for today's show. Let's go on. Or Katie, do we have any questions from anybody today? I'm not tracking on LinkedIn or anything, but any questions?
No, I think we've had some people pop in and say hello, but no questions that I'm showing over here.
All right. Excellent. Well, guys, we got some events coming up here Thursday, October 10th. So that would be in a week, 8 days. On Thursday, we have our Contractors, Closers, and Connections event, which we are sponsoring here in Kansas City. So if you're in Kansas City, want to go see some murals and martinis, we're going to be there at Serendipity Labs in Overland Park. And this is just a great event. They're well attended, really, really high level of people are there, good networking opportunities, great food, great drinks. And if you want to come meet us and talk more about what we've discussed today over the past couple of weeks, we'll be there and we'll be having a good time. So very excited about that. Also later in the month, of October. Oh my gosh, it is October. Later this month, we have the Cash Flow Summit coming up in 21 days. So 3 weeks from now, we have the Cash Flow Summit. I'm going to be speaking on the 24th about Kansas City and investing into the Midwest and all of the new and interesting things that are going on in Kansas City. But come check us out. We got all kinds of speakers coming in town. It's going to be well attended, a great event. It's 3 days, October 23rd, 24th, 25th. Make sure to use my most unique promo code at checkout for a special discount at cfsummit24.com. Type in Logan and you will get a special discount. Should be a great event. Very excited for that as well. We have another one of our multifamily meetup groups coming up here on October 30th, and then taking November and December off and getting back in January 15th of next year as well. And that's at Strang Hall here in Overland Park. So definitely reach out to us in a couple weeks. We also have Blaze from CoStar coming on the Kansas City commercial real estate market pulse to speak all things Kansas City commercial real estate, bringing the most relevant, up-to-date information in a great data-driven insights way. Very excited to have him as a guest on the next show. If anything was interesting to you guys today and you want to learn more about the Kansas City Deal Navigator, about how Exchange Commercial Real Estate can help you find your next investment property, help you with your 1031 exchange, look at the performance of your portfolio of one project, see what the buyer demand might be for that, want to list your project. We are working on 4, 5, 6 different proposals right now. Going to be bringing some listings live here, have some off-market opportunities for folks as well. Definitely reach out to us. You can find me, myself, Logan Freeman, on LinkedIn. Go over to XChangeCRE.com. Plenty of forms. Put your information in. One of our team members will get back to you really quickly. And definitely in 2 weeks, it's not going to be on a Wednesday, right? So in 2 weeks, we have it on a Thursday. Okay. And the time's going to be a little bit different. When you get a speaker like Blaze, you have to sort of work around his schedule. So he's going to be in Kansas City on Tuesday of that week, giving a presentation to the Kansas City, I believe, Regional Association of Realtors here in Kansas City. And then we're going to catch him on Thursday at 3:15, Katie?
Yes.
Thursday, October 17th at 3:15. We've got Blaze from CoStar coming on here. Get us your questions that you want me to ask Blaze. Come view it live. Be interactive with us. We're excited to have him as a guest. And if you're interested in learning more about commercial real estate in Kansas City, make sure to look us up. Katie, any final words?
No, thank you for joining us, for everyone who has.
This concludes the 7th edition. I can't believe in 2 weeks we'll be doing this for, 8 times. So that's 4 months now. And we've gotten some great feedback from folks. But if there are other topics that you guys want us to discuss, or there's a guest speaker that you'd like me to reach out to and have on the show, definitely reach out to me on LinkedIn. Shoot me a note. But thank you for being here. Thank you for tuning in. If you want to find the recording of this, head over to our YouTube channel. Get on our email list. We distribute it all there, and I'll be posting, and Katie will be posting many different snips and clips from today's episode. So much data packed in and so many insights packed into one episode every single week that we are very excited to share on an ongoing basis. Thank you for being here, and we'll see you next time.